Hello, everybody. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on March 21st. I'm Ian Saunders and joined here by Jamie West. Jamie, good to be sitting here across the table from you.
You too. It's been a while.
It has been a little bit. It's been some interesting movement across the market, specifically as it relates to the Fed, interest rates. You're the resident expert on the Federal Reserve. So figured be best to have you on here to kind of run us through what's going on. So just for perspective, we're recording this on Thursday afternoon. Obviously, the Federal Reserve had their meeting this week and then subsequent announcement of interest rate changes and then the news conference Tuesday or Wednesday afternoon at 2 p.m. Um, Kind of as expected, but some surprises in there, right?
Yeah, I mean, it was basically a foregone conclusion that they weren't going to move
So
rates.
they didn't. They left them to change.
Left rates alone. What they did do was they slowed the pace of QT, which is the pace at which they're letting treasuries run off their balance sheet. These are all the bonds they bought during QE. So they were letting treasuries roll off at about 25 billion a month. They're now taking that down to 5 billion a month, which means they're going to effectively be buying 20 billion more in bonds every month to replace what's rolling off their balance sheet because they're only going to let that 5 billion roll off. Interestingly, they did keep the roll off of mortgage-backed securities the same, so no help for the mortgage market.
So how does that like functionally understand? So why do that on the mortgage side and not like functionally? What's the difference? Like,
Their statement is that their long-term goal is to have mostly treasuries on their balance sheet. So they are not going to, slow the roll off of agency securities. Now, functionally, what the effect is, I mean, I think that you could have different opinions. I think probably it is keeping mortgage rates a little bit higher than they would be if the Fed wasn't letting those agency bonds roll off.
hmm
I'm sure someone will disagree with that, but I think that's
kind of functionally what they're trying to keep it high a little bit. And like, well, why? I mean, the housing market's already people have issues.
I I don't know. I was surprised when they slowed QT before and they left mortgages the same because one of the big things people talk about is housing affordability. So, it would seem to make sense that maybe they'd, throw a bone to the housing market, but that hasn't happened. Obviously no one in the Fed answers to me. So
Right. I mean, yeah. I mean, that's so essentially 1/5 of the roll off. They just dropped it down, but 5 billion still seems like a lot of money. But I just looked it up. As of last week, they had 6.76 trillion.
so
It's a lot of money. I mean that
yeah, I mean, it's going to take you a while to work your way through that
right,
at that pace.
right.
Now I don't know the number. So obviously some chunk of that is mortgages. Mortgages are still rolling off full steam. But it's going to take them a while to work through that entire balance sheet.
It's about half of what it was a year ago.
Yeah,
So they're working down,
they're
but
working
it's
their way down.
now working down slower,
Mhm.
which gives them a little bit more flexibility moving forward.
Yeah, I mean, I think there's maybe some concerns about liquidity in the market, so they're not going to be pulling out as much liquidity from the market. Um, I think you can kind of see it as a bit of a dovish move. Now, what
hmm
they didn't do, or what we didn't see, was the members of the FOMC didn't lower their projections for the level of rates over the next 2 years. They were virtually identical to what they were in December. I think a lot of people had thought that they might have a lower projection. We've seen some weaker economic data over the last couple of weeks. The last inflation reading came in lower than expected, almost in line with their goal. I think it was maybe 2.5%.
hmm
But they did not lower their projections for rates, even though they kind of lowered their growth projections. So, I mean, I think maybe the reading between the lines is, they're expecting maybe a bump in inflation from tariffs.
I heard them did they were at Jerome Powell was asked about that in the news conference, and he kind of said, didn't explicitly say, but basically said that the potential inflationary effects might be transitory. We got that word again.
I saw someone from the White House
Okay.
say that it was
Okay.
going to be transitory, and I was like, oh gosh, well, we know how that goes. Whenever
It's
they say
it's
transitory,
it's
it's
not
it's
good.
no good.
Yeah. Um, But so didn't change the projections, did change the quantitative, the QT program or QE program, I guess.
Mhm.
QT program. Um, yeah, I mean, what is markets seem to like that move?
Yeah, I mean, I think, the market, at least the initial reaction, obviously the S&P rallied pretty strongly, finished the day up percent and a half.
Right.
We'll see how that kind of ultimately settles out. I thought it was kind of less dovish than one might expect. I thought they could send a stronger signal by lowering their rate projections, which they
Hmm.
didn't do.
Right. And
Um,
maybe markets are kind of flat a little bit at the time of this recording on Thursday, so maybe people kind of realizing the same thing.
Yeah, I think the market seems to me to have kind of given up on this idea of the Trump put, where if there's enough pain, Trump is going to change his stance, and just because he doesn't like to see the headlines of the market going down, everything that we've heard from the White House has been, there's going to be some pain, and that's just going to be it. So I think a lot of people were looking to the Fed as kind of the last backstop,
Right.
and I don't know if the adjustment to QT is enough to kind of satisfy that. Um, but it wasn't the strongest message that the Fed could have sent.
Right. I mean, so when you think about it, so if concerns around tariffs increasing inflation, meanwhile, Fed is projecting rate cuts, wouldn't the natural assumption be that if inflation remains up and sticky, that they would need to raise rates again?
And that's may very well be why they didn't put in a lower rate projection. They've kind of
So maybe they would have if not for the tariffs. Yeah.
in the past they've kind of said, we're not going to project the effect of political foreign policy.
Right.
We're just going to deal with the effects as they come. So, right now we haven't seen a uptick in inflation from tariffs. We have seen, kind of lower economic numbers. So from that standpoint, maybe you would expect them to, at least until we actually see tariffs cause inflation, say, okay, well, right now we're thinking late rates are going to be lower. But obviously they didn't do that. I mean, you are exactly right. If inflation does kick up because of tariffs, I mean,
Kick up and remain sticky, right? It's kind
yeah,
of not transitory.
not transitory, then yeah, I mean, the natural reaction for the Fed would be to at least hold rates where they are, if not raise them. So, that may be very well what they were thinking is that they don't want to have to kind of go back on their projections.
Right, because they don't want to come off as a decisive.
No,
That's
definitely
the
not.
very worst possible. I mean,
Yes.
you want to have some level of confidence in the moves that they're making, and
Yeah.
they've I think the shortest answer to a question I heard during the post deal was when I think it was someone from Bloomberg asked if he was concerned about being fired by President Trump, and Powell was just basically like, answer doesn't change. Next question.
Yeah.
So at least they're confident in something, right?
I mean, they're very decisive. I mean,
Yeah,
what was it, 22, they said transitory for 10 months or however long it was. So
yeah.
they'll stick with it, even if they're on the wrong side of it.
I mean, it seemed like I mean, up until the last few weeks, there'd been a lot of concerns about a recession, concerns about this, concerns about that. And I mean, it hadn't really come, recession didn't hit when people thought it would. We are in a not necessarily the state of the equity market that is ideal right now, but it could be worse, right? I mean, it's how do you think they'd be navigating this environment? What's your grade on the Fed?
I mean,
It's a tough
overall,
question.
I think they've done pretty well. I mean, we did have 10% inflation. We're down to 2.5 or so. So far, we haven't had a recession.
Right.
So, I think on that, they've done pretty well. I think they're obviously behind the ball
Yeah.
on inflation. Um, but we'll see. I mean, I think this particular Fed, I guess, since Powell has taken over, has dealt with a lot of unique policy challenges.
Yes. In
We've
a very
never,
quick moving market. I mean,
yeah,
it's
yeah,
and
we've
it's so much scrutiny and press on what they're doing all the time. I mean, it's difficult. Every market environment's different. This one, the level of scrutiny on everything seems different than before. I mean, that's just
yeah.
brings a whole other wrench into it. Probably a little bit easier too if they had a better projection or idea of what things would look like moving forward from the potential sticky or not sticky tariffs. So, I guess we'll see.
Yeah, I mean, obviously, the the comments we hear coming from the White House change, sometimes from morning to afternoon
Yeah,
on
or every hour.
what the tariffs are going to be. One thing in the morning at 2 o'clock, you hear
Right.
something different. So, it's very hard to develop a policy plan around that.
Yeah, and I think John Lewis was talking about it on a call that we were on the other day, and I think he did say well that if I mean this administration is they've proven anything they're can be very swift to change. So if I guess hope is if needed that might be something that would be considered moving forward. But in terms of the what has happened over the last couple of weeks heading into this move, we did see some of the participation indicators kind of flip back towards reverse up from washed out territory. But
Mhm.
meanwhile, you have some of the risk off indicators are showing signs of weakness. Like I think it's a can be a difficult thing to look toward relative strength versus participation because they're showing two different things
Mhm.
at some points, right? The participation stuff generally a little bit more near term. A lot of the relative strength indications we're looking at more that intermediate to longer term, right? What are you kind of seeing out there?
I mean, I think it's not even just a relative strength versus participation. In some cases, it's relative strength versus relative strength, giving you mixed signals.
Right.
We've seen U.S. equities kind of fail their bogey check, which is not a great sign. But
And that happens essentially every time you get a 10% correction in the
yeah,
market.
yeah, and this time it happened even before because there's some small cap representation in there, and the Russell 2000 is almost in a bear market, so it actually happened a little bit before we hit the 10% mark this time.
Hmm.
But then meanwhile you have the core of the S&P 500 funds group still sitting near the very top of the asset class group scores. You have money markets sitting near the very bottom.
Yeah, but then again, the core for the S&P 500 Index Funds Group, which is a measures your average fund score of S&P 500 funds relative, right? There's 67 of those funds. Um, it has moved down notably. It was above a five for a while. It moved down to a 4.19 out of six. And so it still ranks seventh out of 134 areas, but its actual score is notably lower than it was before, which I think is important, right? Because if you have there's only six things beating that group right now. It's a weird grouping of stuff at the top. I mean, you have like MLPs, Europe, China, inverse market. It's just a weird kind of dichotomy. But if you had that, maybe even if it remains the same and other stuff improves, I mean that could offer opportunities that you wouldn't have had before, right?
Sure. I mean, it's a very strange environment. Like you said, we are seeing a lot of things move to risk off, but a lot of longer term things are still, looking very healthy. I mean, you know, domestic equity is still at the top of Dolly.
Right.
But today we saw the iShares tactical model pick up a 30% allocation to fixed income.
Because
So
it looks at S&P versus AGG,
yeah,
right?
it's a similar test to the bogey check. And so I think it just becomes a question of where are we going to go from here? I think if we head lower from here, you're going to see some of these longer term indicators start to turn south, um, along with probably the participation
Right.
indicators. And obviously, if we go up from here, you'll probably see the bogey check, things like the iShare tactical fixed income test kind of flip, and it's not particularly rare that we see these things kind of give head fakes.
Yeah, and I think that's how they're designed too. The bogey check, we always talk about it. It's by design going to be wrong more often than it's right. But if it's right, it'll be one of the first things to be right. Right. I mean, so you got to kind of take every move if you're going to take
Yeah,
it.
if you're going to follow it, you got to do it every time
Right.
because you don't want to miss the one time it's going to save you when you've gotten head faked
Every
three
10%
times.
correction doesn't turn to a bear market, but when it does, you want to be out at that 10% correction and
Right.
don't hold it. Yeah. And the iShares tactical, kind of a similar vein, looks at a similar relative strength, slightly different. Instead of stocks versus cash, stocks versus fixed income. But it only removes you to 30% allocation to HEG. It's not like it's flipping you over to fully defensive. It's just adding a defensive just to try to buoy things,
Yeah,
right?
it's taking you out of the matrix, which is about 90% stocks, little few commodities sprinkled in there, and it's going to put you in 30% fixed income. So yeah, just trying to put in some kind of buffer when you do see that market downturn.
Yeah.
Um,
And so that's not meant to flip on a dime, right? I mean, it's meant to be a little earlier, but it's not the thing that like, hey, we're not going to be back in tomorrow or next
No,
week.
and I think the other thing it does is, so the rest of that model is matrix based. So, you get into these downturns, pick up a lot of volatility, so things can move around that matrix a lot more. So it also kind of helps you from getting whipsawed on the matrix as much, just because you have less allocated to it. So you're not, moving as much in and out of those individual funds because they've all kind of given up some of their weight to put it into AGG.
Hmm.
So it gives you a little bit of a volatility buffer as well.
Okay. Interesting. Yeah, I mean, I guess so we'll see how so longer term indicators still showing overweights towards domestic equities. Some of the intermediate term relative strength stuff is it's flipped to a defensive posture, but I think that near intermediate term is the point of the focus there. It's not the long term indicators that are showing a bunch of negative stuff on the horizon, right?
Yeah, and interestingly, we haven't seen international pick up a whole lot of relative strength. I mean, tons of outperformance, but it hasn't moved in Dolly. Have done, I haven't seen a whole lot of things that are really lifting international up in the relative strength rankings.
Yeah, on the relative strength side, but you mentioned on the group score side, we had, right? So we saw Europe and China moved above the S&P 500 index funds group in those rankings. So 134 different areas. I mean, that group scores page is meant to represent your entire investable universe,
Right.
right? Core equity market is represented by the S&P 500 index funds group. Europe and China moved above the core equity market for it's the first time that both of those individually have been above the core since 2017.
Okay.
Um, so they've been above at different points in time, and we know China likes to move pretty quick up and down those rankings. Europe doesn't move as quick, but it
Yeah.
has definitely moved around. It's weird to see Europe and China at the top. I mean, usually Europe being the largest weighting as a regional representative in the developed market space, and China being the largest weighting in the emerging market space. Seeing both of those groups individually above the core domestic equity market is weird.
Yeah.
But you've seen them, I mean, like EUFN, the iShares Internet or European Financials ETF that was up 25-30%. The China Internet KWEB up 25-30%. S&P's down 4%, right? I mean, it's a
Well, I mean, we've seen a pretty notable move towards value
right.
over the last couple of months. And I mean, you look at what, our market versus the European market and the Chinese market have done over the last few years. I mean, Chinese and European stocks both trading at a very large discount to
That's
US
a good point.
stocks on a PE ratio.
Yeah.
So I mean, it does have that kind of value, you know,
Hmm.
tint to it.
Yeah, and everyone's been kind of the conversation, and at least a lot that I've heard over the past couple of years has been when are we going to broaden out from the Mag 7? When is the equal weight going to outperform? When are small caps going to outperform? We've kind of gotten some broadening out. It's just not in U.S. stocks. It's just they're broadening outside of the U.S. instead of broadening out to other areas inside the U.S., right?
Yeah, small caps seem to be, I mean, was it late last year where they just went on an absolute tear? They outperformed,
It was right after the election.
yeah, they outperformed the S&P 500 by like
They were
10% in a
11% in the
week.
fourth quarter. Yeah, it's
Yeah.
crazy.
And then almost immediately they give it all up or almost to a bear market. I mean, there doesn't really seem to be any consistency or um, buyers seem to be very fickle when it comes to small caps.
Yeah. Well,
Um,
the interest rates remaining at more elevated territory than where they were for a while has got to hurt small caps. Then you get tariff concerns thrown on top of that.
yeah.
Tariffs probably going to hurt small caps a little bit more in the large cap space, right?
Yeah. We also saw, high yield spreads reverse up this month. Obviously, a lot of small cap companies kind of falling in that high yield credit range.
Hmm.
So
Hmm.
high yield spreads had a pretty good move off the bottom. They were up about 80 basis points. So
Okay.
raising those borrowing costs for smaller companies.
It's not good for
Yeah,
them.
there just doesn't seem to be, at least over the last couple of years, that we don't be able to seem to be able to get a good sustained trend in small caps. It's
Right.
very up and down and up and down.
Right. Which will be interesting to see if we can get a sustained trend on the international equity space because it's kind of been the same for years on the international equity side, really since the mid 2000s. You haven't gotten a multi-year period of outperformance from that space, right? I mean,
Yeah.
that's been a tough environment. Um, to look toward. And certainly trending to the upside now, but like you said, we'd like to see, or those looking toward international equity investing, like to see some relative strength improvement rather than just absolute price improvement
Yeah,
from some of those areas.
yeah. And you know, I think maybe a little bit more of a gradual improvement. You know, we saw China, was it October last year, where we saw it
Hmm.
shoot up 20% in 3 weeks, and then it
Hmm.
was, you know, down 12 or 15% from the high. And then I mean, it's just not, unless you're just going to white knuckle it, it's not an easy environment because you're just bottom fishing, hoping you're going to catch that 20% jump. And then if you see it jump 20% and start coming back down, it's, well, you know, at that point it looks like a falling knife.
Yeah. Yeah. And I think some of that's because you look at some of those major charts, big spike up, half the spike down, and then a little bit of consolidation
Yeah.
over a few months there. And so now we're starting to break back out to the upside a little bit. That is more consistent. It's kind of what we would hope to see from something. We'll see if that consistency can be sustained
Yep.
throughout the rest of the year. But there'll be a lot to continue to keep an eye out there for. Is there anyone else you wanted to hit on?
No, I mean, I think we've covered everything that's happened this week,
Covered a
right?
little bit, yeah.
Yeah.
I'm sure we could have well, there'll be a whole new slew of information to hit on next week, and then we get into April 2nd when the tariffs are supposedly going to be. So it'll be an eventful next couple weeks here.
Yep. I mean, I'm sure they'll be revised and revised and revised again before they finally hit. But maybe we'll have a little bit better picture of what's going to happen then.
Maybe we'll see. We'll keep fingers crossed. Looking for that. Well,
Yeah.
with that, Jamie, thanks for hopping back on, sitting down here with us,
Thanks, Ian.
and thanks everyone for tuning in this week. We'll be back to touch base on any other action and stuff next week.